Hello and welcome to a brand new show of Market Makers. After a monster rally in the month of Jan and Feb, Indian markets, at least in the month of March, are consolidating. That seems to be the global phenomenon as well. So is this a pause or we have a top in place? What about market valuations? If earnings are not there, can liquidity really take Indian markets and global markets to a different level? Is this case of a rising tide which is taking all ships higher, or it's time to differentiate now? So to talk about sector, themes, valuations, and the overall big picture, I have with me Abhay Laijawala of Deutsche Securities. Abhay, fantastic to have you back. Thank you for joining us.
Thank you.
The screen is telling me, wow, markets, the bulls feel that nothing could go wrong. Nobody believes that there is any risk in the market. And then for me, when everybody feels that risk is over, that is the biggest risk.
Yeah, so you're right, it almost seems to feel that way. But I guess we've got to look at valuations, we've got to look at the fundamentals. And our sense is that at this point in time, we've seen the power of liquidity being unleashed. So in the last 2 months, particularly the rally that we've seen in the Indian markets has taken everyone by surprise, particularly what happened after the budget. We saw the return of foreign institutional investors. Locals had already been buying. But at current levels, the market's trading at close to 17 times if we look at consensus earnings estimates. And our sense is that it's going to be very difficult for the market, liquidity notwithstanding, to just move up on the back of PE re-rating. You need to see earnings growth come back. And therefore, we are recommending to investors that lights are turning amber and there could be a pullback in the market. For those investors who want to stay fully invested and do not want to move into cash, maybe they should look at sector reallocation.
Now, benchmark indices are up by about 8-9% in this year. That's 9% in a matter of just 6 or 7 weeks.
Yeah.
The small cap indexes are 14-15% in a matter of 6 weeks. So do you think large part of the gains of 2017 are already in the price now, and now for the rest of the year we may just hang in there, amble in a range of 2-3%, that's about it?
That's what it seems to be at this point in time, but that can potentially change if we see any uptick in earnings come through, or if the downgrade momentum in earnings comes to an end. So we've got to see what really happens over there. So at this point in time, with where earnings expectations are, what you say is probably going to be the case. But if earnings momentum comes back in a meaningful manner, then perhaps the markets could support an up move.
But Abhay, some would argue that markets are not moving as per the script. US markets were supposed to fall after Trump victory. Trump was supposed to announce business-related moves. Nothing has come out, and there is no panic in the market whatsoever. Similarly, Indian markets were supposed to consolidate and fall after demonetization, and we are almost close to a new high. If 3 months ago I would have made a comment that US markets would be in an all-time high and Indian markets would be striking distance away from an all-time high, that would have been a laughable comment. But the reality is that we are there.
I think what's really shifted the narrative in global financial markets is the expectation or the perception that growth is coming back. And that is always good for equities because growth is always good for earnings. And the expectation, therefore, is that we will see a global reallocation out of bonds and into equities. That we've seen has happened in the United States. That's beginning to happen around the world. In India too, we are seeing part of that happen as the Reserve Bank of India has shifted its stance from accommodative to neutral. So I guess the expectation is that it seems that growth is coming back. So Deutsche Bank also has revised its expectations of growth. In the current year, we're expecting global growth at 3.5% relative to 3% last year. And there could be upside surprises to that, led perhaps by the United States.
Now, you mentioned that it's all about liquidity, and liquidity is like a rising tide which will take all boats higher, all ships higher. As of now, there is every reason to believe that liquidity may not turn for worse. there's a big shift between out of bond into equities. Globally, locally also the SIP culture has started, and typically when Indians, they move in a herd. When you like equities, you like equities, and that SIP culture is only going to pick up. So if one is reasonably sure of liquidity comfort in this market, what happens then?
So what then happens in the absence of overall earnings growth is that the liquidity chases stocks and sectors where there is earnings growth. So there is obviously the potential for those stocks and those sectors to get re-rated further, because that's what would happen, and the overall markets would obviously falter in the absence of earnings growth, and sectors that are laggards in terms of growth will obviously be derated.
Is the leadership of the market changing? Because if I look at the prime gainers for this year, it's Idea, followed by DLF. Reliance has made a comeback. ITC has returned very smartly from the recent low. So it's no longer the good old consumer names or pharma names which are driving the markets higher. A new pack of stocks are moving higher now.
Absolutely. So I guess that trend will probably continue. And perhaps those sectors where there has been a massive derating, and perhaps where the reasons for the derating are now well understood, could probably make a comeback. For example, look at the pharma sector. 5 out of 8 companies under coverage in the pharma sector are trading at very significant discounts to their past 5-year valuations. And what have been the key fears as far as the pharma sector is concerned? It has been the FDA-related worry. There has been worries with regard to what President Trump will do in the United States, and therefore what happens to the outlook for generics. Some of these are now being well understood. So our pharma analyst believes that FDA-related issues are now pretty much baked into stock prices. And Indian companies are understanding the FDA. The observations that are now coming out are not as adverse. So that probably looks like it's in the price. And even as far as what's happening in the United States is concerned, it does seem that the repeal of Obamacare, which is being talked about, would actually be positive for generics manufacturers. So to that extent, those excessive concerns are lifting as well. So we in fact are positive on pharma. We have recently shifted our allocation, our underweight allocation, to now an overweight in pharma.
But you like the top 3-4 names. You're not looking at going down the barrel.
We're going by, in fact, we do not have too many companies under coverage in the mid-cap space in the pharma sector. So yes, the preference is for the larger companies.
The street is divided on how should one value IT stocks. One side you've got genuine H1B visa concerns and real concerns. But IT companies, for the first time, they're realizing that they need to put cash to work, or they need to give cash back to shareholders. Typically, when that has happened in the past, the P multiples of stocks, they get re-rated. But even though TCS has announced a buyback, Wipro has done a buyback, Infosys will consider a buyback, the P multiples are very compressed. Why is that?
That's because I think the market is still not confident on either the return of revenue growth as well as concerned over H1B. Now over here, our view particularly on revenue growth is look at what's happening to the banking sector around the world. With inflation likely to return, with bond yields moving up, with the yield curve sloping upwards, it's going to be very positive for the global banking and financial services sector. So as a result of the stress that the banking and financial services sector globally has seen, particularly in the last 12 months, you had everything going bad for banks, negative interest rates, low loan growth, etc. That led the banks to cut back on IT spending. We think that with the banking sector seeing the terms of trade moving in its favor once again, we probably may see some of the discretionary spending come back.
So how far are we away from that recovery, the business recovery?
We sense that we could probably see that coming through either in the June quarter or the September quarter.
So if you like pharma, if you are bullish on IT, what about inward-looking sectors? Because the India charm for last 18-20 months has been that bet on the local recovery rather than bet on the global recovery.
Yeah. So as far as the local sectors are concerned, we selectively like consumer discretionary. We believe that interest rates in India, which are at an 8-year low, should galvanize the Indian consumer. It's probably the best time to be a consumer in India. And therefore, those sectors that are linked to the interest rate cycle should basically see the benefit. So we expect that the automobile sector should be doing very well. We think that the housing finance sector should do well. However, in housing finance, we believe that with competition in terms of loan growth, the housing finance companies are going to probably see competition from the state banks, from the public sector banks, because that's the only area of growth. So while housing finance demand will do very well, perhaps the housing finance companies may not be able to benefit from it because they will see some of their market share being taken away by perhaps the larger banks, by perhaps the PSU banks, who have all, entered the mortgage market in a very meaningful manner over the last 2 months, given the big surge in deposits.
Last week I had a pleasure of meeting Howard Marks, and what I learned from him was that if a cluster of stock gets a good nickname, there is no discount available on the table. If an asset class gets a bad nickname, that's the space where you should hunt. I get a sense that Indian banks currently have a lot of good nickname, and there are sectors like metals and real estate, they have a lot of bad nickname. So would you agree with this broader assessment?
I don't know, it depends on how you look at it, but we are positive on metals. We think that growth in China should stay supportive. In fact, our China strategist believes that over the last 2 days, announcements from China have been very positive. They're keeping the fiscal stance supportive for growth. While they have not raised their fiscal deficit estimate, they have raised the spending quotas by the development banks. So therefore, to that extent, it does seem that they remain growth supportive. So therefore, we remain extremely positive on metals, despite the run-up that we have seen in metals. As far as banks are concerned, we believe that there are headwinds in the near term.
For the entire sector?
For the entire sector, and particularly headwinds in terms of earnings as early as the March quarter. Loan growth is stubborn at close to 4.8%. The deposit growth has been pretty robust, and the treasury gains could probably erode with bond yields moving up. And our financials analyst, in fact, highlighted this, has cautioned investors. He has cut earnings. In fact, we are probably amongst the first on the street to highlight that these headwinds could impact earnings for financials companies. We've actually cut earnings for financials by 6 to 8%, highlighting some of these concerns.
Which means you are not betting on a big economic recovery, because if you're betting on an economic recovery or revival of capex cycle, then you would have not cut your earning estimates for banks, because if you're bullish, you are bullish. If you're bullish on capex or economy, you're bullish on banks also.
That is correct. That is correct. We are not expecting a capex recovery in the next 6 months, and therefore expectations are that loan growth remains in range of about 8%, 9%, 10% or so.
There are a lot of smaller themes which are at play suddenly. Hospital as a sector has got created. Chemical was or has been a buzzword. Everyone is trying to, buy unorganized sectors which will become organized sector because of GST. So there are a lot of moving parts. I cannot really pinpoint a particular, company or a name right now, but I know these are mega trends in making. Yeah. So what could be the face of corporate India, assuming that we have a lot of new factors which are at play: GST, demonetization, black money becoming white money, digitalization of the economy. What is that new thought which you're communicating to your clients?
I think the new thought that is emerging is that what this government has done is it's leading to an equalization. So clearly there is going to be a lot of tailwinds for the unorganized sector coming through, particularly that part of the unorganized sector that is willing to play the game and benefit from the big recovery that is taking place. So we've had demonetization. Yes, parts of that unorganized sector that are not willing to play the game and who are only surviving because I guess they were using the tax arbitrage as the raison d'etre for survival will not survive. But those that are willing to play the game will obviously survive as they join the mainstream economy. And my sense is that perhaps the SME sector and the services sector are going to be the real surprise areas over the next 2 to 3 years. And what we probably are going to see in India is a data revolution. And we are already hearing about that data revolution. We are going to see this proliferation of data, the proliferation of these small banks. All of this would probably mean that the SME sector moving forward sees a big decline in its funding costs.
So if I'm bullish on the fact that the SME sector will revive, it will survive, and it will grow.
It will thrive.
It will thrive.
Okay. It will thrive.
Okay. So
but yes, we still have the GST coming through. There will be some disruption on account of the GST. But after that, once SME sector has understood that it will have to really play the game, it will have to make a lot of modifications in terms of how it works. It's probably going to be the driver of this economy. It's going to be the driver of growth, perhaps in FY18 and FY19.
So who will benefit the most in the listed space?
So I guess it will be any of the sectors that are consumer interfacing. Okay. It will probably be the small banks.
Okay.
It's going to be anyone who is able to be nimble and start targeting that sector. It will be across different sectors. It could probably be the small banks that have invested in technology to be able to understand the credit history of the MSME borrower, for example.
So you're making a case that HDFC Bank or an Axis Bank, they're important and they are heavyweights, but now it's time to maybe look at old PSU banks, regional banks, smaller banks, which are cluster banks. They understand the local customer. They understand the need of that local customer. And when the SME sector revives, they are in a better position to really help with the customer.
I wouldn't say that it's going to be only the sample that you mentioned. I think any bank, big or small, that invests in technology, any bank that invests in the digital and is able to understand from the data analytics the credit profile of the customer that we are talking about will be the beneficiary. I think we are probably going to see a segregation in the entire banking segment depending on these investments in technology. Because now, as a result of Aadhaar coming through, as a result of everything that is taking place, you are going to be able to understand the credit profile of this new borrower. And this is a completely virgin market. This could probably be the driver of loan growth, perhaps in FY18, FY19 and FY20. And those banks that have invested in the technology and are able to understand the profile of this customer will perhaps be the winners.
Let me take the clock back. Last time we had a conversation on why you like oil marketing companies. You said, look, you have to, that sector was getting re-rated because those companies were now valued as marketing companies. HPCL, BPCL off-rate, they've become slightly rusty. IOC has picked up, but they are no longer close to their highs. Is it a good time to buy into the dip in some of these stocks?
Absolutely. Absolutely. And they are not yet getting the valuations of marketing companies. these, some of the peers of these companies trade at very significant premiums to the valuations that the Indian oil marketing companies fetch. Oil marketing companies are still trading at commodity company valuations.
So there's a case for PE expansion and earning expansion.
One could argue for that, yes.
What could be the fair PE band for them?
I think I would let my analyst answer that question.
But
I would let my analyst answer the question. All I will say is that, the entire move up, or a larger part of the move up in the OMC companies, the stock price appreciation, has been on the back of the earnings growth and has been less on account of the PE re-rating. At some point in time, the markets have to assign a higher PE for the monopoly business. You could almost say that the Indian oil marketing companies are near monopolies. They constitute together about 95% of the distribution in the country. Where are they getting the valuation for that distribution?
It's a difficult business, tough business, and they have a natural moat in that business.
Exactly. And so I've been marketing, in the US and in Europe, and some of these companies are just about coming on the radar screens of investors in Europe and the US who have all missed out on this rally. It seems that the closer you are to India, you have invested in some of these names, particularly the OMC sector. And I think now they are coming on the radar screens of the US and the European investors. So I believe that the PE re-rating will only now start to happen in these sectors.
What else is getting discovered according to you? HDFC Bank, the limit is frozen. All investors or global investors, they have their leg in a TCS or a Infosys. Consumer names are very well distributed by foreign investors. Foreign investors, they still want to invest in India because the growth proposition is strong. So apart from OMCs, what else which is new, different, and it is coming on the radar?
Midcaps.
Okay.
We are, in the last 6 months, in the last 8 months on our road shows, we are increasingly being asked for midcaps. Mid-cap ideas. Up until a year and a half ago, it was only the locals who were talking and who were investing and who were interested in the mid-caps.
But why is that happening?
I think because the growth is outside the large caps. If we look at the average growth, so we did this study, we looked at average earnings growth of the large cap companies, whereas average growth of the mid-cap companies in India. The growth in the mid-cap space is around 25, 30, 35%, whereas for the large caps, the growth is probably in the range of half of that. So obviously, if there is significant earnings growth in the mid-caps, we will probably, and the country is also being much better understood now by the investors. So I think an area where we will probably see more and more interest incrementally is good mid-cap companies across sectors.
So the recent run-up in mid-cap stocks, that does not worry you?
Well, to some extent it does, and maybe there is froth in some spaces. I won't say that continue to invest in mid caps regardless of valuations. There will be froth probably in certain sectors, in certain companies, but I think as an idea, mid caps can still go up far more. We have to just keep looking for more mid-cap discoveries. I mean, look at some of the mid-cap companies. They're no longer mid-caps. I won't name some of them because I'm not permitted to talk about companies. But some of the companies that were mid-caps as early as 1.5 years ago are now moving into the large-cap space. So I think that's probably going to be the phenomenon moving forward in India.
If I have to really summarize the moot point for a bull would be, don't feel embottled. It's time to take cover.
Right. That has always been good advice.
Appreciate your time. So glad you could join us.
Thank you very much.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for joining in and thank you for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.